Folks, if you own stocks, you've got to watch this video. There's a lot that's going to be happening over the coming weeks, and if you don't pay attention, well, you're going to get your rear handed to you. To make an analogy, you know the game of musical chairs where people dance around, and then when the music stops, everyone has to find their seat, and more seats are taken away each round? Well, that's what we're in right now. Imagine you have 100 chairs and 100 companies dancing around the chairs. As long as the music is going, everything is great. Now imagine that all of a sudden 50 of those chairs were taken away. Well, that's exactly what just happened a few days ago. Now, even though 100 companies are still dancing around those chairs, well, we know that there's only 50 chairs left. So that means about 50 are going to be left without a seat, and they're going to be gone, dead. They're basically walking zombies. So everybody in the market right now is panicking, trying to figure out which ones don't have a chair to sit on. And this is triggering a massive contagion across much of the AI and tech world. In today's video, we're going to break down exactly what is going on right now, what news just pulled the chairs under many companies in the market, and how to actually exploit this information by making sure to position before the rest of the market does. Because what you're seeing right now is really just the beginning of a massive rotation. And we're going to break all this down for you, and I'll put the timestamps down below. And then at the end of the video, we're going to go on to our sponsored segment on iSpecimen Inc., ticker symbol ISPC on the NASDAQ. This is a company making waves in the biotech space. Very, very unique. We'll explain why you may want to put this on your radar and begin your research on it. And as always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence on all ideas presented. Okay, let's get to work. So from the get-go, 2026 is a year of opportunity and challenges. There's a lot going on. For starters, we have the dollar melting down. We have geopolitical turmoil. We have massive Federal Reserve shakeups. We have AI paying off huge for some companies. We have AI actively destroying others. We have a lot of fake overvalued AI companies that are basically ticking time bombs. We have historical data suggesting several massive corrections on the horizon, but an overall uptrend. We have margin and fear and drama at all-time highs. So the bigger picture here is 2026. There's a lot to be incredibly bullish on. However, there's also a lot of booby traps. There's a lot of things to shake people out of their positions. There's a lot of panic and fear and also cycles of euphoria that you can expect. And your success by the end of the year is going to be determined on how emotionally stable you are, how grounded you are, how disciplined you are, and how committed to your plan you are. While it's very easy to have analysis paralysis and be all over the place, just understand that long-term, those who buy quality over time tend to do well. If you could just remember that one sentence, well, you're going to be setting yourself up nicely. Okay, so what's the latest news story here for 2026 and why people are panicking? So just the other day, Anthropic, the company behind the Claude AI model, well, they dropped an absolute bombshell. They announced 11 open source plugins for a product called Claude Cowork. Now, Cowork is not your typical AI chatbot. This is an AI agent that can actually do work. It can execute workflows, connect to your existing business tools, and complete tasks from start to finish without a human holding its hand. But out of these 11 plugins, there is one specific one that really freaked out markets: legal. And what it does is it automates contract review, NDA, triage, and compliance workflows. Basically, it does the grunt work that paralegals and unpaid interns used to do. It would take thousands and thousands of these people, and now this AI Cowork bot can do it all. Many unpaid interns are going to lose all of their unpayments. But seriously, this is a big deal, and the downstream effects of this are severe. Anthropic did not frame this as an assistant or a helper. They framed it as something that finishes tasks, completes them. That is a huge distinction. We have had AI copilots for years now, and the market was fine with those. What spooked everyone was the implication that AI is no longer just helping you do your job faster. It's actually going to be able to do your job for you. And this tool connects everything. Through something called MCP, Model Context Protocol, it plugs into your document management systems, your project tracking, your communications platforms. Anthropic's head of enterprise products said it can be your homepage while you interact with any number of software services running through the backend. It renders interfaces directly within itself. So here's the actual question that sent the market into a tailspin. If one AI company can build a tool that replaces entire legal workflows in a matter of weeks, well, what is stopping them from doing the same thing in finance? For HR, for sales, for procurement, for literally any category of enterprise software. And that's what Wall Street is trying to digest right now, and that's what started the trade out of software and is spooking a lot of tech. It's a sell first, ask question second trade, but it's very, very aggressive right now. But there is a level of financial logic to this. It's not just irrational panic. If there's a company that's about to get disrupted by this new AI technology, well, you're not going to want to be left holding the bag on that. It all comes down to something called seat compression. This seat compression is basically how every enterprise software company makes money. They charge per user per month. If a law firm has, say, 500 people who need access to a legal research database, that software company charges for 500 seats. Basically, every SaaS company on earth does this. If an AI agent can do the work of 5 paralegals, that means that the law firm that previously needed 500 seats no longer does. Maybe they need 200, maybe 100. The work still gets done, probably faster, probably cheaper, probably with fewer errors, but the software company just lost 60 to 80% of their revenue from that one client. Now, over time, you can imagine that you're going to need less and less of the software, less and less seats. Now, multiply that across every enterprise customer on earth. That's massive seat compression. And so many companies that have had very consistent revenue recurring for many years and have been growing, well, all of a sudden they have this new massive headwind that is going to completely derail all their numbers. And Wall Street had never really factored that into their valuation models. And so all of a sudden you have to have a repricing, and nobody knows how to reprice because you don't know how fast this is going to happen. But now it's becoming very obvious what's going on. If revenue growth expectations drop because AI reduces the number of humans who need licenses, then the price to earnings multiples that justify these stock prices need to come down too. And when multiples compress on companies trading at 15, 20, 300, 100 times revenue, well, the stock price is going to fall off a cliff. And this gets us to the next section, which is why the sell-off is actually great. So for the last 2 years, we've seen a massive bull market for anything AI related. And many amazing companies came out of nowhere and saw massive amounts of market capitalization increases because they were actually executing and building something very unique and exciting for the economy. However, alongside those, there's been a lot of AI slop companies. When the music stops playing, a lot of these companies are going to lose their seats. Yes, it looks terrifying. Yes, there is destruction, but forest fires burn away the dead wood and the undergrowth so that the strongest, healthiest trees can grow even taller. That is what is happening right now in the market. So if you're somebody that has been holding bogus AI names that have no real value in the economy, no competitive advantage, well, I would definitely not be sleeping so soundly at night holding those. Because quite frankly, they might never come back. If you're somebody who's holding a good stock that's going down because it just happens to be in the AI software space, well, that's a whole nother story. Then you might be thinking, okay, wait, can I get a good deal on this? Can I snap up the dip? Should DCA be a strategy? What's my plan? And so here's the other side of this. The great companies, what's going to happen? The ones with real technology, real workflows, real happy customers that are actually applying AI in a correct way that actually provides real benefits to real people and real companies, well, they're going to make more money than ever on the other side of this. A lot of them are getting dragged down in this panic purely because they happen to be in the same sector as all the junk. That is a gift. That is the market handing you a discount on quality because it is too scared to think straight. If you want to sell first and ask questions second and you're selling first everything at the same time, well, obviously that's going to cause mispricing opportunities. Your job is to do your own due diligence and tell the difference between stocks, which is good, which is bad. And this is an opportunity to separate the best from the rest. So how exactly do you use this to your advantage? 1, separate AI native from AI dependent. AI native companies are building the models, the infrastructure, the compute. They benefit no matter which industry gets disrupted because they are selling the picks and shovels. AI dependent companies are the ones whose core business can be replicated or compressed by AI. That does not mean they are all dead, but it does mean they need to prove they are adapting, not just say it on some earnings call. The ones that cannot prove it are the dead wood getting burned right now. Let them burn. The other ones are going to come back and blossom. Number 2, look at the pricing model. Any company living off per seat, per user licensing is exposed to seat compression. Sorry, but that's what's going on. Ask the question, if AI can do the work of 5 employees, does that company lose 80% of the revenue from a given client? If the answer is yes, that is a ticking time bomb. But if management is already pivoting to value-based or usage-based pricing, well, that shows awareness and adaptability. Those are the companies that survive the fire and grow into the space left behind by the ones that did not. Number 3, and this is really important, especially for those that are Palantir investors and a few others, follow the proprietary data. This is the hidden opportunity that most people are missing. Even if AI completely disrupts the software delivery layer, the underlying data still has massive value. AI systems need data to function. That is a key differentiator. Companies sitting on proprietary data sets, financial data, legal databases, healthcare records, industrial data might see their stock get hammered because the market is panicking about their software layer, but their data moat could actually become more valuable as AI proliferates. Number 4, use the volatility. This is not going to be a one-time event. Every time a foundation model company releases a new tool targeting a new industry, we are going to see sharp sell-off, sector-wide panic, and a rapid sorting of winners and losers. That creates incredible opportunities for people who are prepared. The investors who get hurt are the ones who panic and sell at the bottom. The investors who get rich are the ones who have done their homework and know exactly what they want to buy when the market hands them a discount. And number 5, remember the game. The game is and always has been buying quality over time. Some of the stocks that you're going to see are going to get absolutely destroyed and they're going to deserve it. Others won't, and they're going to be great buying opportunities. A lot of people get upset about this, but I'm not really so sad that overvalued pretending companies that were never really good AI plays are going to get destroyed and never come back. What I am sad about, though, is that a lot of people are going to sell great AI companies. They're going to lose tons of money and they're not going to be around for the resurgence. So please keep that in mind. Understand what you're actually owning and holding. And if you're owning something that's actually a diamond, well, maybe consider not panic selling because somebody wrote something negative. Maybe consider DCAing and getting a good deal. This is a big gift. This market environment we're in is a big gift, and you got to treat it like that. If you go back to all of our videos throughout every bear market, well, almost always we said, look, bigger picture. Yes, rotations are painful. Yes, corrections are painful. And yes, bear markets are painful. But if you just extend out the chart and you just extend out the time frame, well, guess what? That was a great opportunity. So anyways, bigger picture, the game of musical chairs has been going on for a while. Chairs are being removed, and this week was the moment that the entire room looked down and realized there are a lot more dancers than chairs. Now, the music really hasn't stopped yet, but for the first time, everyone can see the chairs are missing, and there's a lot of panicking going on right now. But the smart money isn't panicking. They're looking for which companies are actually going to have chairs at the end of the day, because those, well, they're going to have more money than ever. So anyways, let us know your favorite ideas down below, your take on this current market environment, and now it's time for our sponsored segment. Time for our sponsored segment on iSpecimen, ticker symbol ISPC on the NASDAQ. They've built what is essentially Amazon for human biospecimens. And I know that sounds niche, sure, but stick with me because this is one of those quiet, boring sounding industries where the inefficiency is absurd and the opportunity could be pretty massive. So here's the problem. Every time a pharmaceutical company wants to develop a new drug, every time a researcher wants to study a disease, every time a diagnostics company wants to validate a new test, well, they need human biospecimens. We're talking blood samples, tissue samples, plasma, serum, immune cells, actual biological material from real patients. And right now, the process of getting those specimens is an absolute nightmare. Researchers describe the biospecimen procurement process as challenging and inefficient. In a 2022 survey, 78% of researchers said they find it difficult to extremely difficult to find the type and quantity of specimens that they need. Think about that. The people doing the most important medical research in the world are being bottlenecked by a broken supply chain. On the flip side, healthcare providers are sitting on mountains of unused specimens. Over 3 billion clinical specimens are discarded worldwide every single year. Hospitals, labs, blood centers, biorepositories, they have the supply. Researchers have the demand, but connecting the two, it's still done the old-fashioned way. Cold calls, emails, relationship building that takes 6 to 12 months just to get started. It's fragmented, it's slow, and it's holding back medical research. That's where iSpecimen comes in. Think of it as a marketplace like an Amazon or eBay, but specifically for biospecimens. Researchers can go onto the iSpecimen marketplace, search for exactly what they need to use filters like disease type, demographic, specimen format, country of collection, and more. They could search through over 80 million clinical specimen records and over 15 million patient records. They can get quotes, place orders, and track everything through one platform. On the other side, healthcare providers can list their available specimens and monetize what could be otherwise thrown away. iSpecimen handles the compliance, the contracting, the logistics, all the messy stuff that used to take months, and the traction is real. iSpecimen has agreements with over 140 supplier organizations, hospitals, clinics, pathology labs, biorepositories, blood centers spread across the US, the UK, Germany, India, and more. On the demand side, they have over 600 customer organizations, and here's the stat that jumps out. They have worked with 70% of the top 20 pharmaceutical and in vitro diagnostics companies in the world. These aren't small players. We're talking about the biggest names in pharma and diagnostics using this platform. Cumulatively, iSpecimen has delivered over 175,000 specimens across more than 2,400 projects. The biospecimen contract research services market is growing at a double-digit compounding annual growth rate driven by the booming demand for precision medicine, regenerative medicine, cell and gene therapies, and the overall expansion of the biologics pipeline. This is a market that's going to keep growing because the research isn't slowing down, it's accelerating, and iSpecimen has been named a top competitor in the space by industry analysts. The company also has a growing data set, over 80 million clinical specimen records, over 640 million laboratory test results, over 1.2 million bank specimen records, which positions them for future adjacent opportunities like clinical trial recruitment and data licensing. As one industry report from Frost & Sullivan put it, utilization of sample data for research and for monetization is the next key value driver for the biobanks. iSpecimen is building exactly that. Now let's talk some of the risks because this is a risky company. First, iSpecimen is not yet profitable and operating expenses are running ahead of revenue. They've had to raise capital through multiple offerings, which means dilution for existing shareholders, and this is a microcap stock, which means it can be extremely volatile and extremely illiquid. There's also management turnover to consider. The company has gone through multiple CEO changes over the past couple of years. They're all risks that you need to weigh, and you're going to want to go through their SEC filings to make sure that you're familiar with everything. But overall, what makes iSpecimen interesting is the core thesis. thesis. They're digitizing a massive, inefficient analog industry. If they can continue to grow the marketplace, expand the network, and move toward profitability, they're sitting at the intersection of healthcare, technology, and data in a market that's projected to grow significantly over the next decade. The question is whether they can execute fast enough to get there. Anyways, if you want to learn more, I'll put the link to their investor relations page down below. Make sure to look over what they got for you, as well as the SEC filings, and do all of your own due diligence. Anyways, that caps off today's video. Have a great rest of your day. We'll see you next time.